their interest in regulation, securities markets are aligned pretty much. You see this where Hester Pierce is on this crypto task force, stood up at the beginning of the year, and also you see acting chairman Ueda, before Atkins was appointed and formally sworn in, was actually laying a lot of the groundwork for the Atkins tenure. And that includes, among other things, you can see it in the dismissals of a lot of the lawsuits against crypto sponsors that were being sued for failure to register one way or another. You see it in dismissal and termination of investigations relating to what was called the off-channel communications investigations. These things are basically what's going on between these two new things that have gone on with the enforcement arm of the commission. Reflects that as Hester Pierce has said over history, and so is the chairman, and so is Commissioner Ueda has also said, that before they start doing enforcement actions, they need to give clear guidance to the industry, and that includes the investment management industry. So we're going to see a lot more guidance, a lot more rulemaking initiatives. In the meantime, they're also very interested in innovations. So you can see this happening in small increments already. Like just yesterday, I believe, was the SEC came out and told single stock ETFs that you didn't need a benchmark index anymore. The benchmark index that they've been required to generate really was kind of a very weird thing. It had to like track the volatility of the performance of the fund, and it was made up of other companies in the index. It was a very strange beast that was being forced on the industry, and I think to a certain extent had the effect of restricting the number of single stock securities ETFs out there. So this is a potential for more growth in that area because of this lightening up of regulation. We see other things going on in other areas of the commission, especially in investment management, in particular investment management, I should say. You see a lessening of the conditions of relief for where closed-end funds and business development companies can get affiliate co-investment transactions. The conditions are substantially lessened. There's still work to be done. But another trend is, and you see it with the ETF share class relief exemptive applications. The pattern is a pattern application. You see it in the co-investment applications, and you're going to see it more and more in these large efforts by the staff to generate exemptive relief. But like, for instance, closed-end funds that can privately placed closed-end funds can get multi-share class relief from the SEC, and you're seeing is them insert it as one of the conditions in all these applications is that this exemptive order, if it's granted, will be rescinded if and when the SEC generates a rule on this very topic of the relief. So it means that they're definitely going to get back into regular order, looking at the areas where they've been issuing lots of exemptive relief. They've get a lot of experience with a lot of this already, and it's becoming, some of these areas are becoming ripe for rulemaking. And I think that's kind of the practical approach to the industry to foster innovation. We'll continue seeing that. We'll see areas where they can look at rules to reinterpret rules, reinterpret prior relief to knowing that they've accrued some experience of how the industry reacts to the relief, to figure out how to make it more flexible for the industry to continue innovating. Clearly, when it came to the class ETF share class relief, the SEC could have. They actually heard back in March. I heard from the acting division director. She was saying how they thought about going rulemaking, but the commissioners thought it would take too long, so they're just going to continue on with the exemptive applications. That's sort of like the spirit. They're moving with speed, and they're trying to accommodate the industry as we have not seen for several years already.
Carrie, would you like to add to that?
Yeah, no, well, and it was a good point that you made about the dismissals. We've also seen the delay in the compliance dates for at least the names rule, some reporting obligations, I think on importer, I forget which ones, which is another good sign as well. I think that maybe this administration is going to think through new rules and new amendments to existing rules that haven't been implemented yet, and really just see, like, do we actually want to do what was adopted by the prior administration? So that's also potentially a good sign that more industry-friendly changes might be coming.
Stephanie?
Yeah, and I think the exemptive relief point you made is really important because it seems like the new SEC came in and said, what can we do right away to give the industry some wins, if you will. And so you have co-invest relief. We are going to talk about ETF share class relief in a bit, and then semi-transparent, for instance, the SEC recently issued an order that allows, and it's baby steps, I would say, incremental. As many of you know, I'm sure, semi-transparent ETF relief right now is largely limited to U.S. equity securities, and this expands the relief at least to allow other investments provided they're fully disclosed. So we saw a few developments kind of right away from the new SEC.
It's semi-transparent. That's
So we've mentioned the ETF share class a couple of times, even in this discussion. Maybe we switch gears and get more into that. We could touch upon the SEC process, conditions for relief, board approval. We've chatted about that. Plumbing issues. I'm a plumber, right? And my favorite is distribution. Maybe we could touch upon that, and other issues as well. Carrie, maybe you want to start us off here, and then others can jump in.
Right, sure. Thanks, Chris. And it's great to be here with everyone. And I know that you might have already have heard some things about ETF share classes, but this will be the best presentation. I have some notes just because there's so much to cover. So forgive me if I refer to them from time to time. But as you probably already know, there's been a clamoring for ETF share class relief. There's over 50 sponsors that have submitted applications for the relief. We think that relief is coming. It's not exactly clear when, but all signs seem to be leading to an indication that the SEC is willing to accommodate this. So if helpful, just provide a really brief history. Starting in 2000, the SEC did provide relief to the provider of index mutual funds, which is Vanguard, and they also they obtained a patent on the structure. The patent expired in 2023, which really opened the door and provided others with an opportunity to kind of go for the same relief. But at the same time, the SEC had expressed that it has concerns about the structure. And so the applications now are tending to that. There's, as I noted, there's about 50 applications in. One of the first sponsors, which is Dimensional, recently filed its second amended application last week. So things have changed a little bit, but for the most part, the structures is there in terms of the terms and conditions in the application. Most of the changes related to what would be expected for advisors to put in their reports to the board, and also what the board would be required to find. So I'm just going to go through. Oops, sorry. We'll go through what's in the applications now. And just to point out, it's actually good to see this amended application, even though it kind of, you feel like it starts the clock running again. For me, it kind of signifies that maybe the staff is more clear and has solidified what they want as far as the terms and conditions to give relief. If they're engaging with the applicants, that's a good sign that they're getting closer to at least establishing what they're going to need to feel comfortable approving the application. So aside from the recent revisions in this most recent filing, most applications are pretty much substantially similar, which is the norm. What you want to do is include in your application everything is, that's reasonable. That was in the most recently approved application. The order would, based on the current applications, provide the relief necessary to have one exchange-traded class of shares, and that would permit the standard ETF operations consistent with Rule 6C11. And just to remind you, that rule, the ETF rule, was adopted in 2019, amended in 2020, and it basically allows ETFs to operate without having, certain ETFs to operate without having to get exemptive relief. In adopting the rule, though, the SEC decided to not provide relief for ETF share classes. It said that there was policy concerns with that structure that weren't attended to with 6C11, and that basically is driven by its concerns of cross-subsidization. So, for example, certain costs would be generated by one class but borne by all of the shareholders. So the terms and conditions and applications now are really intended to address that. The SEC was also concerned about transparency. The funds would also be subject to Rule 6011's requirements, such as daily portfolio transparency. They need to disclose what the holdings on a daily basis. So that's just some background. What's in the application and what are boards and advisors going to be required to do? This is going to be a huge ask for everyone involved. So boards are going to be required to determine that the plan is in the best interest of each class, not just the ETF class, but also the mutual fund class and the fund as a whole. This is a real ask for boards as it's new territory. There's not much historical context against which they can judge their assessments. I think that boards are going to be demanding in the information they get from advisors, from other service providers, maybe go beyond just what they're required to get in the exemptive applications. It's also a big ask for advisors. They're going to have to generate a whole host of data, which I'll talk about briefly. And it's going to be hard for them to come up with a lot of this information. They may have to rely on service providers, which also might be reluctant to provide data that they're not used to providing. So it's going to be a challenge. So in order for the boards to make this determination that it's in the best interest of everyone, advisors are going to need to provide them with some data on which to make this determination. And these reports, at least initially, need to include a description of the reasonably expected benefits and costs to each class individually and the fund as a whole. It's going to need to include information about sources of potential cost savings and other benefits of having the dual class structure, how each class will be impacted by cash flows, portfolio transaction costs, cash levels, and distributable capital gains. Also, how the advisor intends to manage the expected costs associated with the transition to a dual class structure, and how the fund's investment strategy is really appropriate for this structure. Again, can it accommodate, is it appropriate for daily transparency and what's in the portfolio? At the time of the board's initial approval, the advisor must also provide the board with a framework, including certain numerical thresholds. And those are all intended to help the board assess how this structure is going to operate, especially in terms of like conflicts of interest and managing those. So the thresholds are going to relate to costs associated with portfolio transactions, cash levels, and capital gains distributions. Once things are up and running, provided that the board approves the structure, the advisor is going to need to advise the board if any of those thresholds have been exceeded. So that's one thing down. First, the board needs to approve it. Then they must continue to assess whether the dual structure continues to be in the best interests of the classes and the funds as a whole. This again is going to generate the need for advisors to provide more information and ongoing board reporting, talking about things like observed benefits or cost savings to the fund from the multi-class structure. Also material conflicts of interest among the classes and negative consequences to a particular class. How the creation and redemption activity of the ETF class affects the mutual fund class, how shareholder redemption and purchase activity of the mutual fund class affects the ETF class, and so forth. Performance differences relating to dividend payment date differences. So just generally, just going back to what I mentioned before, just thinking about the challenges here, boards have to be comfortable making a determination that this is in the best interests of the fund. Advisors have to be comfortable giving these reports. They're going to have the information to comply with the applications and the order terms and conditions, but also any additional requests that the boards have. I also don't want to forget about the division of examinations kind of lurking in the background. I'm willing to bet that if one of these dual class structures is adopted, that's going to be at one of the top of their priority list when they go in for an examination, and they're going to question, why were these thresholds exceeded? Why did you come up with these reasonable determination or these reasonable estimates of costs and benefits when the actual costs and benefits are such and such? So, there's a lot here that's putting both the advisor, the fund, and the board at risk. So even just, let's assume that the exemptive order is granted and you have board approval. There's additional things to think about. First, you need to amend the registration statement to register the share classes. That's going to be another involvement with the staff. you might get through, like the application might be approved, but you still have to get your staff reviewer to sign off on all of your disclosures. Even if there's this, automatic 60-day effectiveness built into the rule, you don't want to, well, I was going to use a bad word, but you don't want to anger, let's say, like your reviewer. It's better to respond to their comments, and they may have some comments on the disclosure. There's also, getting to your point, the plumbing and operational issues. Consider the advisory and other fees and expenses. Your ETF typically has a unitary fee. It would be hard to carry that across the fund. So, how do you allocate, like if you have a common advisory fee, how do you get it fair to the point where the ETF is bearing only the costs and expenses that it should be bearing? How do you also don't want the mutual fund bearing the fees and expenses of listing and money and market maker expenses. So all of this really considers the equitable and fair treatment of the classes. Also, the exchange function. Applicants have been asking for mutual fund class shareholders to be able to exchange those for ETF class shares. That's going to be a huge challenge for everyone involved. You're essentially having side-by-side pricing, singular NAV calculations within a really short period of time. It's questionable whether service providers can actually handle this in the time they need to handle it. The distribution issues. I think there's a fear that the ETF share classes means the immediate demise of mutual funds. I think there's some legitimacy to the concern, but that might not come as quickly as I think some people think. Reg BI, I think it's probably the biggest concern to date, because with broker dealers needing to come up with a determination for investors that are most suitable, that's in the best interest. How do you choose anything other than a share class that's the least expensive, that provides exposure to the same fund? But at the same time, there's a payment and capacity concern. There's only so many authorized participants and market makers to go around. If there's this huge explosion in the number of ETFs out there, which essentially this would be, I think there's going to be, they're going to be stretched pretty thin. We're going to have to go through potentially non-traditional courses of distribution. So it's the capacity concern. It's also not a guarantee that all platforms are going to want to carry these ETF share classes. I think, platforms have a pretty strong due diligence process when onboarding a new fund. And that's essentially, what this would be. And they're going to want to get comfortable that the funds are up to speed, can handle everything, can actually operate the way that they're supposed to operate. So I'm not sure that it's necessarily, day one, even once we get approval, once boards approve, I'm not so sure that it's going to meet immediate, sales of all ETF share classes.
A lot to do. Thanks very much, Carrie. That's quite a list. And as a service provider, we're considering a lot of those things as a legal underwriter. Peter and Stephanie, would you like to add to that? Stephanie?
I'll actually add one additional item to the list too, which is, of course, once we have the 1940 Act relief, I think people are still thinking through the Exchange Act relief. So there's class relief that 6011 ETFs rely on with respect to various provisions of the Exchange Act that are relevant for broker dealers trading in the shares. And so the industry is still working through kind of what that looks like, whether there will need to be individual relief or whether that will be class relief as well. And I think we're certainly hoping that it's class relief similar to 6011 to really streamline the process.
Peter?
Yeah, one thing to keep in mind is that there's a demographic issue going on with the investment management industry, retail investment management industry, and that is the younger investors love ETFs. So taxable investors really like ETFs because of the tax efficiencies within the portfolio, that the reduction in the amount of annual distributions out of the ETF because of the tax efficiencies of the in-kind creation redemption process that's going on, tax management in the portfolio. Mutual funds are really something that the older generation investors who are essentially in retirement programs, the 401ks, the pension, defined contribution plans, things like that. The tax investors are still going to be around. They're still going to be using mutual funds, mainly because a lot of the administrators of those programs aren't just equipped whether they're, whether they want to be equipped or not is another question, but they aren't equipped to deal with constant churn of trading ETF shares throughout the day. They do a 1 o'clock strike, 4 o'clock strike on the mutual fund trade. They can net it out internally amongst their plan participants and then present a net trade at the end of the day. So there is a difference between the two, what type of investors are two different types of mutual fund class, ETF class appeals to. And a lot of sponsors out there, long-time mutual fund sponsors, are looking, where are we going to be in 20 years? So the writings on the wall, there will be ETFs. Now, a lot of these folks are already running their own ETFs. They've started that process. They're now getting into issuing new share classes, ETF share classes. A lot of them are out there with the applications already. I think this is all to a positive good. I think that for the normal ETF investor, the younger ETF investor, it is opening up to them a whole new cadre of professional investment managers who've been very good in the mutual fund format, who are now going to be available to them through an ETF format. So there's a, we've talked, I know the prior panel today, is Brett Eichenberger still here? Brett had a great panel earlier today about ETF share classes. The one thing to note is that you alluded to is that there's only so many market makers out there.
Has to be.
And we had like this geometric increase in the number of ETF products being released. And so there's a capacity issue. Now, there's some people would say that's basically the ETF industry has always come up with the solution one way or another, right? So we'll let the market makers figure that one out. Where's Reggie? We'll make Reggie figure that one out. The underlying takeaway here is one theme I mentioned earlier on is that the SEC is looking at these things more rationally and more efficiencies to and foster and empower the industry more to do the right thing. And one of the things about the recent amendments to the ETF share class application was to actually make the burdens on the advisor and the burdens on the board less by giving them more discretion to determine what's important for the board. And so you don't, for early applications, it was very specific, prescriptive. Yes, prescriptive, very prescriptive. So it's more principles based now, which is good. That gives people a lot of flexibility. It doesn't make it any less burdensome, but it does give you a lot more flexibility, less of a pitfall.
So lots and lots of considerations. We spoke of board considerations, advisor strategy considerations, service provider considerations. That was a panel earlier that mentioned that, Mike Pendergast.
Yeah, when we get SEC relief, it's not over, right? You have to go through the board process. So now you're looking at sometime late this year, first ETF share classes maybe. You got to get through the plumbing issues. That has to be done in train with all this other stuff.
Plus the 1,000 that are already planned
yes.
to be
and you really have
launched
to
this year, ETFs that are planned
and
to be
a
launched.
lot of our clients who are mutual funds, primarily mutual fund sponsors, are now really heavily involved with ETFs. They're the ones who are going to succeed the best with this kind of stuff, like pending ETF share classes to the mutual funds, because they've already developed a distribution power inside their own organization. They know how to distribute ETFs. That's, distribution, coming up with a distribution plan, and then also dealing with the financial market intermediaries.
Yeah, no, completely
Last
agree. I
point.
mean, at this point, it seems we are, I think, many, many months away, right, from actual ETF share classes happening. This is obviously a welcome development because I think we were very much stuck from a regulatory perspective for a long time. But now we have kind of all of these operational issues and whatnot to work through.
Well, there's a lot to plan for. I know firms like ACA Foresight, others have working groups where we're trying to determine how we're going to handle this or that. So when the time comes, we definitely, it'll probably be sooner rather than later. We'll be ready to go. In interest of time, maybe we switch gears. There's been a lot discussed today about ETF share class. Why don't we turn the discussion to crypto assets? Maybe we could start with a little bit of defining what that might be. That's been brought up at a couple of panels today. Some of the trends, on crypto, From a regulatory, Peter, you mentioned the task force, I think, and maybe we could talk a little bit about that. Stephanie, maybe you can start us off on this discussion.
Yeah, sure. And it seems like we have a lot of developments on this recently. And so there's like a 90% chance that whatever I say right now is actually going to be out of date based on something that happened this afternoon. But I guess just kind of stepping back, what are we talking about here? So crypto assets, assets that are generated, issued, and or transferred using a blockchain or a similar distributed ledger technology. So virtual currencies, tokens, and the like. And there are really two primary things that we think about in connection with crypto assets. And one is funds investing in crypto assets. And I know we've talked about, there have been panels that have discussed that a bit today, and we'll discuss it a little bit further now. There's, of course, also funds that are themselves tokenized. So the shareholders are on the blockchain. Won't be talking about that right now unless others want to, but there could probably be a whole panel on that. Another distinction to keep in mind, just as we're kind of setting the stage here, is the distinction between 1933 Act ETPs and 1940 Act ETFs. And the nomenclature gets a little bit confusing, I think, because 1933 Act ETPs are often referred to as ETFs, but the distinction is 1933 Act only, I should say, ETPs are registered under the Securities Act. So they are publicly offered, but they are not registered under the Investment Company Act. They are actually not registered to invest in securities. So an Investment Company Act ETF invests in securities, generally at least 40%, and is subject to the whole regime of the 40 Act, so board oversight, portfolio limitations, et cetera. So the first products we saw here really were 40 Act Bitcoin futures ETFs. So not the later products we saw in, I think, January 2024, which is when the Bitcoin ETPs launched. And that was the real splash, of course. That was followed not too long afterwards by the launch of the Ether ETPs. And so both these Bitcoin and Ether ETPs, they're spot Bitcoin and Ether. They're basically kind of direct pass-throughs, providing exposure to these cryptocurrencies, similar really to the gold and silver ETPs that have existed for quite a long time. So that was, of course, last year. Turning to more recent developments, the pace here has really, really accelerated. So as Peter mentioned, earlier this year, the SEC launched a task force led by Hester Peirce. That I think was a welcome development for the industry because she is really well known in terms of being crypto favorable. And the purpose of the task force was really to provide regulatory certainty with respect to cryptocurrencies. There's a lot of uncertainty that exists in the regulatory framework as to which ones are securities and which ones are not, among other things. But also really to protect investors, but at the same time allow this industry innovation so that we can continue to see the industry grow and develop. So even just after that, there were some developments. The staff of the Division of Corporation Finance issued a statement clarifying that certain US dollar-backed stablecoins are not securities under the federal securities laws. And then they also issued a statement basically outlining disclosure considerations for these types of issuers so they can have this guidance in terms of the process for registration. And then Chair Atkins, when he came on, outlined his crypto priorities, which really made clear that this focus is going to continue in terms of creating a clear regulatory framework and also allowing for innovation. His priorities, again, focused on whether crypto assets constitute securities, providing greater optionality for custody, and modernizing the technology associated with trading systems in order to allow greater investment in these types of products. And as Peter also mentioned, there's really a clear focus also on moving away from regulation by enforcement, right? There have been various suits that have been dismissed, and the clear message has been that the SEC is looking to provide more guidance through the regulatory framework rather than through enforcement. So that then brings us to now, where I would say we've had, even just in, I think it's the last week, we've had some pretty significant developments in this space, particularly as they relate to ETPs. And so the first one is the SEC staff and FINRA staff withdrew their 2019 joint statement on broker-dealer custody, which really made it difficult for broker-dealers to custody crypto assets. And at the same time as they withdrew, they issued FAQs that basically address crypto and blockchain related activities by broker-dealers and transfer agents. These FAQs really make clear that broker-dealers can take custody of these types of assets under certain circumstances. And then, of course, I think the question is, why is this important to ETP issuers? And the key is that to date, the authorized participants engaging in creations and redemptions with respect to the ETP products in the market have done so in cash, in part to address this custody issue. The creations and redemptions have also typically involved a non-broker-dealer party as well, rather than the authorized participant directly. So really kind of a more cumbersome process than is necessary with respect to most ETFs and ETPs that we see. The FAQs do confirm that broker-dealers can facilitate in-kind creations and redemptions in spot crypto ETPs. So that is a really welcome development for the industry and will hopefully streamline the process. That said, of course, similar to ETF share class, I think there are some steps that will need to happen in order for this to be affected. 19B4 filings, disclosure updates, operational hurdles to work through. But again, a recent a welcome development given the prior scenario. And then the second one is that on May 29th, so again, very recent, the Division of Corporation Finance issued a statement on certain protocol staking activities. I will not get into the specifics with respect to staking, mostly because
Come on.
Define it.
Okay, so staking involves using cryptocurrency holdings to validate transactions on the blockchain. So if you have holdings, you essentially offer them for use for this purpose, and you receive rewards. So really more cryptocurrency. This is only available or only part of the process with respect to certain types of cryptocurrencies. So, for instance, staking does not exist with respect to Bitcoin, but it does with respect to Ether. So you can probably guess where I'm headed with this, which is that with this staff statement, which says that certain staking activities do not involve the offer and sale of securities, the expectation is that Ether ETPs will be able to engage in staking. Again, various operational and other matters that I think will need to be worked through, but another regulatory development that it will certainly be helpful for the industry. And of course, the last question that always comes up, and I'd be interested in others' views on this, is, what products will we see next and when? And that I do not have an answer to in terms of the when, but of course, we've seen filings with respect to Solana, XRP, Polkadot, et cetera. And we could do a whole separate panel on the SEC's views with respect to what is necessary in order to support the trading underlying these products. But again, I think given where we're headed, hopefully we'll see more soon.
Peter, do you want to add to that? I want to
Yeah.
bring to the attention, we'd like to have a few minutes at the end
Sure.
for some
Sure.
questions. If there's any
I
questions.
mean, what we're seeing is a lot of what you're now seeing is tokenization. You can tokenize Solana. You wrap Solana in a token. You can put it inside an ETP. We're seeing that done with not only other digital assets. By the way, when I say digital assets, I mean crypto assets. It's the same thing. So it's just not cryptocurrency. It could be anything that relies on a distributed ledger kind of networking. So there's a lot of creativity out there in the digital asset land, and there's a lot of interest in using exchange traded products as a mechanism for increasing transparency into the pricing of the products themselves. It's sort of like a feedback loop. You know, you get the token trading on Coinbase or Binance or something like that, and then you have an ETP that's referencing a price, the blend of that. Maybe it's a weighted average or something like that of that pricing mechanism, and that increases the visibility and transparency of the underlying asset. I think what we're seeing a lot of is that the SEC is definitely gating these things based on how robust is the underlying assets market, and what does it mean to be robust. Knowing that a lot of precious metal pricing is done in single point auctions. Sometimes it's based off of some gold trusts are basing their pricing off of a index built on a data feed, 24-hour, 7-day a week gold price, cleared price data feed. So it's not just auction pricing, it could be a data feed. You can see a variety of mechanisms being used to pricing ETPs using digital assets. So it's a fascinating time. It's very much the world to come.
One thing I'd like to add is, and you touched on this a little bit, hopefully we'll see clearance for more and more products. But now if you have especially like an index fund that's investing in spot Bitcoin or spot crypto, there's not a whole lot that they can actually invest in. So even if they're tracking a certain index, you might only be able to invest in certain components of the index. And so if you have multiple funds that are kind of also tracking the same index, how do you differentiate yourself when there's not that much you can do? So hopefully there'll be like a little bit more flexibility, more competition, with more avenues of creativity.
It's like basically the growth of active management. It's going to help. It's going to hit the crypto asset space. It's going to be actively managed crypto funds. It's going to be a blended portfolios, and it's going to be up to portfolio management talent to figure out what their weights are.
So we've blended in a lot of the outlook and potential items to come. Are there any others that you'd like to add? You've done a nice job kind of blending in kind of what you think may be coming. Any others to add, Carrie or Stephanie?
I have things I'd like to come.
Things that you think potentially are on the horizon?
I mean, I think there's more that can be done, and this administration could potentially be more open to more flexibility, more openness in terms of private debt ETFs, more alternative strategy ETFs. So hopefully that's on the horizon. Other things that don't even, they're not specific to ETFs, but I'd love to see more in terms of guidance and relaxing the rules a little bit. Things like, do we really need in-person meetings anymore for auditor approvals, for advisory agreement approvals? That's something that was, adopted in 1940 when Zoom wasn't a thing. So, maybe more flexibility on things across the board as opposed to just being limited to ETFs. But within the ETFs, I think there's we talked a little bit already about semi-transparent ETFs, but and also in the process of exemptive applications, there did start actually when I was on the staff this process of incorporating by reference precedent, and that's supposed to speed up the process of the submitting an exemptive application. You don't have to go through everything. You can just incorporate by reference whoever you're following. That would be great if that gets incorporated in more than one way.
Great. Stephanie, anything to add? Then we can maybe, if there's any questions. Good.
I think we've covered
All of
quite a
it?
bit of ground.
So
Yeah.
we have about 3 minutes left. If anyone has those questions.
Yes.
Screw something up, but it seemed like with the spot Bitcoin ETP approvals, per the lawsuit that Grayscale had won, there was just like, look through argument that they had won, where if there was listed futures that ultimately there was kind of like this modus tollens type of look through that allowed for the spot Bitcoin ETPs and also the Ethereum ETPs to launch as well. Any like more elaboration on what kind of standard, if it's a similar type of look through standard that can kind of get through the 19B4 process for addressing like market manipulation or an underlying market of sufficient size?
Yeah, this goes to robustness. To a certain extent, the CME futures markets in Bitcoin and Ether, that really sort of like went to the argument whether or not the listing exchange for the ETP could have a market surveillance agreement with some other regulated exchange that satisfied the statute requirements. And so that was kind of getting you there. But you look at a lot of the Bitcoin and Ether products, they're not necessarily using the CME price to price their products. They're using like weighted averages of like 6, 7 more cryptocurrency exchanges that are actively trading throughout the day around the world, and they take the weightings of the average volume, for instance, is one way of doing it. And so having the CME pricing was there, but I can tell you, having gone through that process with trading in markets, is that to a certain extent, a lot of their objections started falling away when they realized that a CME 0-day future contract, which is essentially a spot price, was actually pretty much highly correlated throughout all time periods to these blended pricing mechanisms of using these other exchanges. So it's, DIRA was involved. And those are the economists at the commission who crunched the numbers for the other divisions. And they were sort of like, they could see that high correlation. They said, yeah, there's actually assurance that this pricing mechanism that you're using for your digital assets is actually valid. And so when I was talking about before about using a data feed of closed or settlement prices, closing transaction prices, I mean, that is also a viable way to address this, where you just have to make sure that's a deep enough market, that it's representative, that there's some governing controls that are valid on it. So you get into the debates with the staff all about that stuff when you're looking at listing rules. And so you try to build it in such a way so it's what I call robust.
Thanks for the question. I think we had 1 or 2 more questions, one right here. And then we have time for one over here.
In terms of all these crypto filings, there's like 80, and you go from like altcoins into like meme coins. And one of the meme coins is the Trump coin ETF. And I'm not kidding. How are they not going to approve this if that's their boss? Right? Like, you can say that this ETF is not appropriate for retail. So if they have to approve the Trump ETF, wouldn't they have to approve all the rest ipso facto?
Who wants to take that one?
The agency, the staff of the agency has to get political buy-in to approve these things. And the basic principles they're outlining to us now, that we've seen in recent activities, that by the staff issuing guidance and questions that make us think about what we must put in disclosure, including about the guidance about the robust market supporting this thing. They're not going to walk away from those principles, because the minute one of these things blows up, they're all getting hauled in front of Congress and being accused of the worst regulator they've ever seen in Congress. So there is potential reputational blowback for the agency. Also, you keep in mind the SEC is, yes, apparently the Trump administration is looking at the potential to fire commissioners of quote unquote independent agencies, but the SEC is viewed as an independent agency, and that's something that the Trump people will have to live with. They're going to go through the same hurdles all the other people. That's how I view it. I know it's like basically they started working on that meme coin, the Trump meme coin, starting in January of 24, and here we've got a filing by them. So I understand. I don't think there's ever. I've seen so much as a a heavy hand to approve things based on politics. I've seen a heavy hand to deny approval of products. That's why I've seen more and more of them around.
Both sides, both sides. Do we have time for one more question or? One more question, gentlemen. He was like the first gentleman. We'll take questions afterwards. We can meet in the back.
I hope you don't mind a broader question, but you all have extensive experience with independent directors and boards, and you've touched on a couple of the issues that have arisen. I think back to when ESG was a big thing, everyone was like, oh, we need an ESG expert on the board. Or cybersecurity. Oh, you know what, maybe we should have a cybersecurity expert on the board. Board construction is really interesting now where all of these different things are kind of bubbling up. So I'm wondering from a board construction perspective with ETF share classes, like, is this different? Do mutual fund boards need a quote unquote qualified ETF expert? Do we need to think about construction of boards in a new way in light of these developments?
Great question.
Potentially like training, being familiar, but also I think the more important aspect is, do you have a board that's engaged in asking the right questions? Which, I don't think you necessarily need to have like all of this, a ton of familiarity with ETFs coming in. But I think being able to ask the right questions, challenge, assess the information you're given, and then be able to evaluate it is probably a more important aspect. I don't know if either of you agree or disagree, but I'm not so sure you need a specialized expertise.
Yeah, agreed. I think general industry experience, such that directors can be engaging with the concepts and whatnot, I think is just as important.
I think some sort of financial or financial industry literacy is important for any board member on an exchange trade product or a mutual fund for that matter. The specialized knowledge for the ETF, it goes to things like understanding what's a bid-ask spread mean for the ETF shares. You don't deal with that with mutual funds. What's coming up with share classes now, you see it now, it's like this concern the staff has clearly about conflicts of interest between the classes and the board's role in addressing conflicts of interest. And it may, it's basically do something about it, or maybe we have to revisit whether or not this ETF share class makes sense for us at all. And so the focus is now on getting information to the boards that the advisor thinks is important about this. And so now the boards are going to have to really think hard and be led by their advisors, whether it's independent trustees council, the accountants, or people in the portfolio management team are going to have to explain to them in detail what this is all about so they can make an informed decision. I don't think there's any specialized knowledge. There's no one except for maybe some Vanguard directors who've been dealing with this, right? But we don't know what they do.
Going about it their own way too, in a way that's, they deal directly with their shareholders. So I think a lot of the issues that are coming up now haven't been necessarily seen at Vanguard.
So thanks for the questions. We had a couple of additional questions. We can meet in the back if you want to see us in the back. Well, no, there's one more panel. We're not standing in the way of drinks, but great job, everyone, team. Round of applause for them. Thank you.